Okay, so let's start. We want to start this new topic, and the topic is called cost of capital. So what we want to talk about is what is cost of capital and how do we calculate the cost of capital. Now, cost of capital is normally defined as the expected return by the providers of capital, Whatever is they're expecting as their return, that becomes a cost to you as a company in trying to raise finances. Okay? Whatever the providers of capital are expecting as their return, that will automatically become a cost to you as a company. That will become a cost to you as a company. Okay? Now, we also know that there are different sources of capital that you as a company may use to raise your capital. There are various sources of capital. One, you can raise capital through what we call the equity capital. You can raise capital through what we call equity capital. The other way is to raise capital by issuing what we call preference shares. So you raise capital by what we call preference share capital. The third way is raising capital is through what we call the issue of debentures. You can issue debentures or debt instruments. Good. So these are the different sources of capital that you as a company may use to raise your finances. And each of these sources have their own cost. Now, when it comes to equity capital, you know equity is anything that belongs to shareholders. So as a company, you may raise capital by issuing through equity capital. You may raise capital, by issuing what we call ordinary shares, issue of ordinary shares. That's one way under equity capital. The other way you can still raise capital through equity capital is to utilize whatever we call the retained earnings. Whatever are the retained earnings in your company, you can use them to finance your business. You have been retaining some profit over the years. You can use them to finance your business. Okay? Remember, instead of you distributing the profit, you retained it. Good. Let's compute or discuss how do we compute the cost of each component of each component of capital. How do you compute the cost? Now, we can start with the cost of ordinary shares. How do we calculate the cost of ordinary shares? Now, when it comes to cost of ordinary shares, there are various ways of computing the cost of ordinary shares. I have told you, listen, that what is cost of capital? It is the expected return on providers of capital. So these providers of capital called shareholders, ordinary shareholders, what is it that they're expecting as their return? They may expect dividends. Okay. Alternatively, there are those who expect what we call earnings per share, for example. So they may rely on dividends as their return. Alternatively, they may also have what we call earnings per share. They may rely. Don't forget, earnings per share is also something that belongs to shareholders. Good. Now, let's start with the first one, where they are relying on dividend. If they are relying on dividend as their return, then the way to calculate the cost of ordinary shares on the basis of dividend, then one way is to use what we call the dividend price model. Use what we call the dividend price model. And under this model, to compute the cost of ordinary shares, we shall be taking, this is KE. We shall be using KE as a representative of the cost of ordinary shares. Okay? Good. So to get the cost of ordinary shares, we shall be taking dividends. Whatever is the dividend, I'm representing it by D. You divide that by PO. you divide that by PO. Now, of course, you have done ratios. Listen, you have done ratios. And you know, when you take dividend per share, you divide by the market price per share. That is what you used to call the dividend yield. Don't forget, that's what you used to call dividend yield. That represent, listen, when you take dividend per share, you divide by the market price per share, you get what we normally call the dividend yield. And the dividend yield normally represent the real return to the providers of ordinary shares. Good. So we are saying D divided by PO being what we call the dividend yield, and it represents the real return to the providers, that being what they are expecting as their return, becomes now a cost to you as a company. So to compute the cost of ordinary shares using the dividend price model, we shall be taking the dividend per share. You divide that by the market price per share. This D, we shall be reusing it to be D, we shall be taking it to be whatever is the expected dividend per share, whatever is the expected dividend per share. While PO, we are taking it to be the current market price, the current market price, the current market price. Okay, that's what we shall be using PO to be. Then, of course, you multiply this by 100. You multiply that by 100. Now, that's one way of computing the cost of capital, the cost of ordinary shares using the dividend price model. Okay, good. Now, what if in your company, the company that is issuing these shares, they have a history of paying more dividend every year? In other words, there is a growth in their dividend. The formula I have used, listen, the formula I've used here called dividend price model is a formula where we use this formula where dividends are, listen, we normally use this formula where dividends remain constant, where dividends remain constant forever, where dividends remain constant forever. Where dividends remain constant forever, then you just take the dividend per share, you divide by the market price per share, you get the dividend yield, which is the return to the providers, which becomes a cost to you as a company. Then, of course, you must take it as a percentage. So we normally use this formula where dividends remain constant throughout, where dividends remain constant forever. Okay? But if your company has that history where dividend keep growing, then you use another formula now for computing the cost of capital. And that formula is what we call the dividend growth approach. Dividend growth approach. Dividend growth approach. It is also normally referred to in finance as Gordon's model. We normally call it also Gordon's model. We have not discussed this Gordon's model. We shall discuss it later in another topic, but just know we normally call it Gordon's model. In another topic, which we shall be calling dividend policy, is a topic we shall be calling dividend policy. We shall be talking about Gordon's model in details. But for now, we are computing the cost of capital. And I've said where there is a growth in dividend, maybe every year your dividend in the company grows by 5%. How do you compute the cost of capital? How do you compute the cost of capital? So we normally use this formula where there is a growth in dividend. Where there is a growth in dividend, in other words, listen, we normally use this formula where the rate of dividend growth remains constant. where the rate of dividend growth remains constant. In other words, listen, in other words, your growth rate of dividend may be 5% every year. Every year your dividend grows by 5%. 5%. So what is the formula? To get the cost of capital, which is KE, again, it will be dividend 0, explain in a short while, into 1 plus G, divide that by PO plus G. So this is the formula we shall be using where you are given an indication that there is a growth in dividend. There is a growth in dividend. Don't forget the first one was just PR, D divided by O, D divided by PO, D divided by PO. But now we are saying if there is a growth rate, then this is the formula we shall be using. Now, DO there represent, listen, DO there represent the current. What have you paid in the past? Like last year, what was the latest dividend that was paid last year? Then if you multiply that by 1 plus G, let's assume the growth rate is 5%. If your dividend was 10 shillings last year and we expect it to grow by 10%, then the growth rate being 10%, it is like saying we expect a dividend of 10 plus into 1 plus 0.1. We expect maybe the growth rate to be 10%. So if the dividend was paid last year of 10 shillings and we expect our dividend to be growing by 10% every year, then we expect a dividend of how much? It will be 10 times, or 10 into 1.1. So we expect the dividend there to be 11. Okay. The other year it will grow by another 10%. So that is what we are saying, where we expect the growth rate to be constant. Where we expect the growth rate to be constant, then we use this formula. I have said D represents, or D0, sorry, represent the last dividend that was paid. Meaning, when you take the last dividend of 10 shillings, you multiply that by 1 plus G, you get what we expect. Listen, we get what we expect to be the dividend at the end of the year. And what we expect to be the dividend at the end of the year can also be expressed as D1. We shall be using D1. Listen, we shall be using D1 to represent the expected dividend. The expected dividend. Then you divide that by the current market price, then plus G, plus G. So this is another way of expressing the cost of ordinary shares where there is a growth rate, Otherwise, this formula can be derived. We don't want to derive it now, but there is a way to derive this formula of the cost of capital where there is a growth rate. There is a way to derive it. We don't need to derive. What you just need to remember is how to use it to compute. The examiner will not ask you to derive it, but you need to know that there is a way to derive this formula. So we have said, if the examiner, listen carefully here, if the examiner gives you the expected dividend, he says the current market price per share is 20 shillings and the company expects to pay a dividend of 15 shillings. The company expects to pay a dividend of 15 shillings. That is not what they have paid. They expect to pay. That becomes the expected dividend, which becomes my D1. And if the question tells you the current market price per share is 20, last year the company paid a dividend of 5 shillings and it's expected to grow by 10%. So if last year, or maybe the question tells you the latest amount paid as dividend is 5 shillings, that 5 shillings becomes your D note. D note. Are you there? D note becomes your 5 shillings. The latest dividend that was paid. But if the question tells you the expected dividend is 7, that becomes your D1. I hope you are getting my point. So there are times you may be required to use the first formula, or there may be a time you may be required to use the second formula, depending on the information the examiner has given you. I have said the numerator represents whatever is the expected dividend. What are we expecting as dividend at the end of the year? That is the numerator. Okay? But how to get that numerator, I have said, now will depend on the information given to you by the examiner. If he gives you the actual expected dividend, that becomes D1. If he gives you the amount paid as dividend last year, then that becomes D0 or D0. Then you now multiply it by this factor of growth, which is 1 plus G. Then, of course, whatever you get as your dividend yield, which is this one, you add the growth rate. You add the growth rate. Are you there? Good. Now listen. That is the approach we call the dividend growth approach. The dividend growth approach. Now, what if the investors are expecting some earnings, not in form of dividends? They are expecting earnings, maybe earnings per share as their return. So there is another way of computing the cost of ordinary shares by what we call the earnings price approach. The earnings price approach or model. The earnings price approach or model. Okay? Where we are saying to get the cost of ordinary shares KE, get the cost of ordinary shares KE, you take what we are calling the earnings per share. You now divide that by the market price per share, which is DO. You multiply that by 100. Multiply that by 100. This is where the earnings are expected. Where we expect the earnings as our return, then you use the earnings price model. Of course, most questions will give you scenarios where we are expecting dividends. But in case they ask you to calculate the cost of capital using the earnings price model, then you take the earnings per share, which is what I'm representing as E, you divide that by the market price, the current market price, PO. Then you multiply that by 100. Are you there? Good. So far, don't write. We shall put down everything. I hope you have managed to get something so far. I started by discussing how to compute the cost of ordinary shares, and I took the first way, which was the dividend price model. And I said that price model is used where we expect no growth. Listen, where we expect that there is no growth. In other words, the dividend remains constant forever. That is the dividend price model. Okay? The dividend remains constant forever. Are you there? Good. That's what I said. Then the second one I said, what if from our company we expect there is a growth in dividend? And that's what we are saying, where we expect the growth rate to remain constant. The growth rate to remain constant, then we use the second formula, which is what we are calling the dividend growth model or approach, which I also called the Gordon's model. The person who came up with it is called Gordon. I've said we shall discuss this in detail when it comes to the topic of dividend policy. Even how to derive this formula, how to derive that formula, I said there's a way of deriving it. Good. I've said under dividends growth model, you get the cost of ordinary shares, KE, by taking DO into 1 plus G, everything divided by PO plus G. I have said DO represents what? The last dividend. The last dividend paid. Are you there? Good. Then I've said, if the examiner gives you what the company expects to pay as dividend, then you use the expected dividend, D1, the expected dividend, because it has already captured the growth. So in other words, we are saying D1 is the same as DO into 1 plus G. I hope you are getting. We shall put down this. Then I've now talked about what is the earnings price model if we are expecting in terms of earnings. So KE becomes earnings per share divided by market price per share times 100. Good. Now listen again. As a company, to raise this capital by issuing shares, we are trying to compute the cost of ordinary shares. So to raise capital by issuing ordinary shares, listen, you as a company, you may incur what we call the issue cost, or some books will call it flotation cost. Yes, you issued one share at 5 shillings or 10 shillings or 20. But to get that 20 shillings from the investor, it costs you another 1 shilling or 2 as what we call flotation cost. So if there is a flotation cost, then to compute the cost of equity, where there is flotation cost, then to compute KE, this is flotation cost, we are trying to incorporate. Okay, so I'll take KE equals to D1 divided by P0 minus F. Listen, I told you, listen, D divided by P is the same as the dividend yield. It shows the real return to the providers. Okay, now you as a company, you issued a share at 20 shillings. But to raise this 20 shillings, it's costing you another 1 shilling as the flotation cost or the issue cost. So the real amount you actually received is not 20, but 19. That's why we are saying where there is flotation cost, you take the price PO, you minus the flotation cost, then everything you add plus G. This is still the dividend growth model, but with the incorporation of the flotation cost, Good. So I have discussed how to compute the cost of ordinary share capital. Either using the dividend price model, where we are expecting no growth, 2, using the dividend growth model, which I've also called Gordon's model. 3, the earnings yield the earnings approach of earnings price model. And now we are saying where we expect some flotation cost, then we are modifying the formula and taking it to be D1, which is the expected dividend, divided by PO minus F, which is the flotation cost, plus G, which is the growth rate, Good. I think now we can put down something. We can now put down something on that. Now, before we put down something on what we have already said so far, listen, before we put down something on what we have already said so far, some of you are new to this group. And so if you are new to this group and please you have not subscribed to my YouTube channel, please click that subscription button. Subscribe to my YouTube channel. Click that subscription button. Subscribe to my YouTube channel. Okay? So that you may get notification whenever we post new videos into YouTube. So if you are here or watching this video and you have not subscribed, please subscribe. Just click that subscription button down there and subscribe. Okay. You can also like the video. I hope so far there is something you have learned. Click the like button. Click that like button. Good. To like the video. The other thing I want to mention is this. If you have friends who are doing financial management, which is what we are doing now, and you would wish them to join our online classes, then you can recommend to them. Tell them we are having financial management as online classes. We have online classes for financial management, which is of the intermediate level. We also have online classes for financial reporting of the intermediate level. We also have online classes for advanced financial reporting for the advanced level. And we also have financial accounting of the foundation level, and the one of ATD level 1 and level 2. Those are the 4 subjects we are offering online classes for. So if you have friends who have not joined the classes, the online classes, please tell them that we have online classes for those subjects. 1, financial management of the intermediate level. 2, financial reporting of the intermediate level. 3, advanced financial reporting of the advanced level. 4, financial accounting of the foundation level, and that of ATD1 and ATD2. Anyone who would wish to join our classes can reach me on this number 0722 65 8875. 0722 65 8875. So that's my number. Now, also note this. If they may not be able to join the live class, or if you are not able to join the live class, then you can still buy what we call the pre-recorded videos. You can also buy the pre-recorded videos where you can watch the videos at your own free time. For any of these subjects, you can still buy the pre-recorded videos and you watch them at your own free time. Maybe you have no time to join the live class, you can still buy the pre-recorded videos. Good. So tell your friends that we have our online classes for these 4 subjects, and that's my number where they can reach me anytime. Either they call or they text, we can still communicate. 0722 658875. Good. Let's put down something now. Now I think we can continue. We can put down something on what we have already said. We have so far discussed how to compute the cost of ordinary shares. The cost of ordinary shares. So let's put down what we have so far said. Okay. So Andika topic is cost of capital. Put down the topic cost of capital. Let's put down the notes now for what we have said so far. The topic is cost of capital. Cost of capital. And then you say this. Put down this. Cost of capital is the return expected. Cost of capital is the return expected by the providers of capital. Cost of capital is the return expected by the providers of capital. By the providers of capital. By the providers of capital. Okay. Another paragraph. The cost of capital may include. The cost of capital may include. The cost of capital may include 1. The cost of capital may include 1. Equity capital or cost of equity. Put it that way. Cost of capital may include 1. Cost of equity. Under that you can have the 2 branches. Under that you can have the 2 branches. Issue of shares, or we can just call it ordinary shares. Under that, under cost of equity, have the 2 sub-branch. You just say ordinary shares. This is ordinary shares. And the second branch is retained earnings. Then number 2, the second cost of capital is what we are calling cost of, number 2, cost of preference share capital. Cost of preference shares. Cost of preference shares. Cost of preference shares. That's number 2. Number 3, call it cost of debentures. Cost of debentures stroke debt. Number 3, cost of debentures stroke debt. Cost of debentures stroke debt. Cost of debentures stroke debt. Then you can have another subheading. Cost of ordinary shares. Let's start with the ordinary shares. Cost of ordinary shares. Cost of ordinary shares. Then you say this. There is not a single method. To calculate the cost of ordinary shares. There is not a single method to calculate the cost of ordinary shares. There is not a single method to calculate the cost of ordinary shares. The following are some of the methods of computing. The cost of ordinary shares. 1. Dividend price model. Then you say this, dividend price model. This model is used. That's note below that. This model is used where dividend remain constant forever. This model is used where dividends remain constant forever. This model is used where dividends remain constant forever. Then you can now put down the formula. KE is equals to D divided by PO times 100. Then there you can say where KE is equals to cost of shares. KE represents the cost of shares, or you can even say cost of ordinary shares. KE represents cost of ordinary shares. Then you can say D represent what we are calling expected dividend. And then PO is what we call the market price per share. And listen to this. Whatever market price you are supposed to use is what we call the market price, which is ex-dividend. That ex-dividend market price. The market price which is quoted as ex-dividend, not cum dividend. The one which is quoted ex-dividend. Good. That's the first way of computing the cost of ordinary. That's one way of computing the cost of ordinary. So finish. We want to go to the second way. We want to go to the second way of computing the cost of ordinary. Want to go to the second way of computing the cost of ordinary. Number 2 or B. Number 2, andika dividend growth. Dividend growth approach. Dividend growth approach. Call it also Gordon's model. Gordon's model. Call it Gordon's model. That is the second way of computing the cost of ordinary shares, depending, I've said, depending on the information the examiner will give you. Okay? Good. Put it down. Dividend growth model. Then let us quote the formula first. KE equals to D naught into 1 plus G. Maybe you could put down the information first. Before we quote the formula, put down this information, Before we quote the formula, put down this. Sema hivi. This approach is used where the rate of dividend growth remain constant. Where the rate of dividend growth remain constant. Then you can now quote the formula. I was saying KE equals to D naught into 1 plus G. Divide everything by PO plus G. I've told you there is a way to derive this formula when you incorporate the growth rate. But for now, we don't need to know how to derive this. Just need to understand it. You just need to understand it. Then I can say down there, or, put down this, or KE equals to D1 divided by P0 plus G. That's another way. I have already explained the difference between these two. I've explained the difference. It's only that they give you the same answer, but the one you use depends with the question that you are given. Then you can say there again, where, below that, you can say where DO is most recent dividend. And put in bracket dividend per share. The most recent dividend. The last one that was paid was which one? That is the one I'm calling DO. Okay? Then you can say D1 equals to the expected dividend. D1 equals to the expected dividend. Expected dividend. Maybe you can put below that D1 equals to D naught into 1 plus G. Expected dividend, which is D1 equals to D naught into 1 plus G, so that you know the numerator is the same. It's only that you either express it as a D1 or you express it into as a D naught into 1 plus G. Okay? Good. Then we can put down G. We are still quoting the symbols. G represents the growth rate. And PO represent the market price per share. And I told you again, it should be X dividend. That market price should be quoted X dividend. It should be X dividend. Good. Then you say this. NB. We have already discussed it. Where flotation cost is incurred. For new issue of shares. Where flotation cost is incurred for for new issue of shares. Don't forget, we only incur flotation cost when you are issuing shares. Okay? So we come and now say this will be given by KE equals to D1, divide that by P0 minus F plus G. So we have only incorporated the D at the F. So you can even add there where F equals to flotation cost. Where F equals to flotation cost. Where F equals to flotation cost. Good. Okay. So that is the second formula for getting the cost of capital. That is using the dividend growth model. It's the most common one, the most commonly used. Okay? The most commonly used approach. But maybe before we do a small illustration, let's put down number C. Number C, earnings price approach. Earnings price approach. Earnings price approach. Earnings price approach of computing the cost of capital again. Come and see your KE equals to earnings divided by PO times 100. Earnings divided by PO times 100. Where E equals to earnings per share. Earnings per share. Of course, you know PO is the market price. It's the market price. Okay? Good. That is it for the ordinary shares. So before we go on, let's maybe put down a small illustration. Let's put down a small illustration for that now, just to illustrate how to compute the cost of capital. Then you see this example. Let's put down an example. Example. Say this. A company, can put down this illustration now. A company's with an apostrophe, sorry. A company's current market price. A company's current market price per share. Current market price. The company's current market price per share is shillings 150. The company's current market price is shillings 150. Will stop. The flotation cost is 3 shillings per share. The flotation cost is 3 shillings per share. Is 3 shillings per share. Will stop. Continue. The expected dividend. The expected dividend at the year end. The expected dividend at the year end is shillings 14.1 or 14.1 per share. We are saying the expected dividend at the year end is 14.1 per share. And the growth rate is 5%. And the growth rate is 5%. And the growth rate is 5%. Required, calculate the cost of ordinary shares. Calculate the cost of the ordinary shares. Calculate the cost of the ordinary shares. So let's calculate now the cost. Of course, we are using the dividend growth model. Dividend growth model. Okay? So let's quote the formula is equals to D1 Don't forget, I've already been given the expected. Listen, from this question, we were given the expected, not the amount paid, the expected dividend. So it will be D1 divided by P0 minus F plus G. That's our formula. D1 divided by P0. Now we have introduced the concept of flotation cost. So you minus the cost. When you take the P0 minus flotation cost, you get what we call the net proceeds. You issue that share for 50. The cost of raising this 50 is the cost of 2 shillings per share flotation. So effectively, the net proceeds are 48, something of that nature. Okay, good. Let's feed in the figures now. We can feed in the figure. We expect a dividend of 14.1. We take the market price, which is 150. That's what we have been given. 50. We minus the flotation cost, which is 3, plus the growth rate, which is 5%, which is 0.05, which is 0.05. Let me solve this. This will be 14.1 divided by 147 plus G, no, plus 0.705 plus 0.705. So this will become, if I divide that 14 if I divide 14.1 by 147, I'm getting something like 0.0959. Let me make it to 4 decimal points. Then I come and say plus 0.05. So this will be, what does it come to? Let me add 0.0959 plus 0.05. I'm getting 0.1459. In terms of percentage, if I multiply by 100, this will be the same. This will be the same as 14.59%. 14.59%. Good. That is it for that cost of ordinary shares. So finish. We want to develop the topic slightly now. We want to develop the topic slightly. We want to develop the topic slightly now. Okay. So before we go to the cost of retained earnings, remember we are still discussing the cost of equity, which comprises of the ordinary and the retained earnings. But before we discuss the cost of retained earnings, listen to this now. We have been using this figure called G, growth rate. Listen, growth rate. Sometimes, listen carefully, sometimes the examiner does not give you the growth rate. Sometimes the examiner does not give you the growth rate. So how do you compute the growth rate? If the examiner has not told you, we expect the dividends to grow by 5% every year, whatever. So how do you calculate? So that's what we are trying to do. Listen, don't write. Computation of the growth rate. Now, there are two methods. There are two methods of computing growth rate. There are two methods of calculating the growth rate. One method is what we call the compounding method. The compounding method. That's one method of computing the growth rate. Let me explain it first. Now, to get this growth rate, the rate of growth, we shall be determining it by saying, using this formula, it will be G into, let me put it first before I explain it, G into n minus 1 into the root of dn. This is dn. I will explain in a short while what they represent. dn divided by do everything from there, you minus 1. You minus 1. Let me explain what they mean. N is the number of years. The examiner will give you, listen, the history of the company. Dividends last year was this, the other year it was this, the other year it was this, the other year it... Remember, we are looking for the growth rate in terms of dividends. What is the dividend? They are growing by what percentage? We are looking for the growth rate of the dividend. So the examiner will give you maybe the last 5 years dividend. Okay, that becomes our N. If it gives you a history of 5 years, N becomes 5. If it gives you 6 years, then N becomes 6. You minus 1, and then whatever you get, that becomes the root number. Okay, maybe it's 3 minus 1, you get the square root. If it is 4, N being 4, minus 1, you get the third root of whatever you are getting in bracket. Now, D0 or D1, sorry, DN represent, listen, DN represents the latest dividend that has been paid, the most recent dividend. The lot is the last dividend that has been paid. That becomes D1, DN. Listen, D0 is, or D0 is the first dividend that was paid. Let us assume, listen, let us assume now that the company paid the following as dividend. In year 1, that is what I can call DO, starting, they paid a dividend of 8. D1, following year, they paid a dividend of 8.1. DO at D3, they paid a dividend of maybe 9. And D4, which is maybe the latest, let us assume they paid a dividend of 3.6 and 9.6. So these are 4 years dividend records. So the N is 4. Listen, the N is 4. And we are looking for growth rate. Listen, the first year, the dividend grew from 8 to 8.1. That became the first growth. Then from year 2 to year 3, this became the second growth. This is first growth. This is second growth. Then from year 3 to year 4, that was the third growth. So though the dividends were paid for 4 years, our growth only, the dividends grew by 3 times. Listen, that's why when you look at the formula, it is N minus 1. So that you get how many growth were there. From this simple illustration, there were 3 growth. From year 1 to year 2, that was 1 growth. From year 2 to year 3, that's a second growth. From the third year to the fourth year, that is the third growth. So we are taking N being the number of years, you minus 1, you divide that. No, that means then you take now, listen, you take now that to be the third root, because N is 1. Maybe you can put it this way. It is 4 minus 1, 4 minus 1. Then you take the latest dividend to be DN, which is how much? 9.6. You divide that by, which is the first dividend, which is 8. Good. Then whatever you get, you now subtract 1. You now subtract 1. That will give you the rate of growth. Okay? Let me just do that as a simple illustration. So this is third root of what is 9.6 divided by 8. 9.6 divided by 8. If I divide that by 8, I get 1.2. Okay? Then I minus 1. What does that come to? I get the third root of 1.1, 1.2. So 1.2, what is the third root of it? I'm getting something like the third root of that is 0. No, not 0. 1 point is 1.0626. Let me put it to this 4 decimal point. That is 1.0627. Then I minus 1. If I minus 1, this will become 0.0627. Now, if I express it as a percentage, this will be 6.27%. That's how we are determining the growth rate. Okay? That's how we are determining the growth rate. Listen. I have given you the formula of determining the growth rate. It is n minus 1 root d n divided by do you minus 1. Listen carefully. I have said n is the number of years the dividends has been paid. 5 years, 10 years, and so on. You minus 1. Why do you minus 1? So that you determine how many growth were there. Like in this illustration, our growth were 3 times. The growth took place in 3 times. First growth, second growth, and third growth. Then you minus 1. Okay? D1, D note I've said is the last dividend. First dividend, sorry, D note. DN is the latest dividend. Good. Now, for the sake of understanding clearly, listen, for the sake of understanding how we are deriving this formula called G or growth rate, let me just remind you a small thing because we have already covered it in the topic of time value of money. I just want to use that topic of time value of money to just illustrate to you how this growth rate was determined. Okay? You know, from our topic of time value of money, we discussed how to get future value. So we are just saying recall. Don't write. We recall that future value is equals to present value into 1 plus r to the power of n. Are you there? That was our formula for getting the future value. Our r is what I'm calling the growth rate. Our r here is what I'm calling the growth rate. So like I want to solve for r. So if I want to solve for r, what do? I divide both sides by what? By PV. So if I divide both sides by PV, then it will mean 1 plus r to the power of n, which is the left side. If I cancel it against, okay, maybe I could just put it this way so that you understand. This is PV, no, V divided by 1 plus r to the power of n equals to PV into 1 plus r power of n. Sorry, I'm dividing by PV, sorry. I'm dividing by PV, not by 1. I'm dividing both sides by PV. So I divide this also by PV. So this will mean my PV on the right side will go with against the PV there. So this is power n, sorry. This is power n. So this will now leave me with 1 plus r power of n is equals to FV divided by PV. Are you following? Then now let us solve for R. Let us solve for R. To solve for R, I can take this nth root of both sides. Are you seeing? I take the nth root of both sides. Okay? So this is the same as 1 plus R. If I take the nth root of this side, it will leave me with 1 plus R equals to nth root of FV divided by PV. Now listen, I am still looking for R. So to get R, I take 1 to the other side. R will be the nth root of FV divided by PV, everything minus 1. Everything minus 1 if I take it to the other side. So this is generally how the growth rate is derived, the growth rate formula. Okay? They are deriving it from the present value factor. Okay? Good. But that is what is important is to just know how do we compute the growth rate. How do we compute the growth rate if it's not given? I have said To get the growth rate, it is the root n minus 1 into dn divided by do, everything you minus 1. This is our formula for getting the growth rate. One of the ways of getting the growth rate. I said there are many ways of getting the growth rate. Normally, again, there are normally two. That's one. Let me discuss the second one. I've already also illustrated how to compute growth rate using this history of the dividend. D1, D2, D3, and D4. Our D note was 8. Our D4 was 9.6. So D4 becomes our DN. 8 becomes our D0. Then you divide those two. Then whatever you get, you take root of 4 minus 1. Why am I taking 4 minus 1? So that I get the number of growth. How many growth are there? 4 minus 1 is 3. Then you minus 1. Good. That's one of the formulas or one of the ways of determining the growth rate. Now let me discuss the second way of computing growth rate. Number 2 is what we call the retention ratio approach, or retention method approach, retention ratio approach. We are still trying to compute the G, which is the growth rate. Okay? And to get the growth rate using the retention ratio approach, we normally say G is equals to R times B small e. B small e. Good. Where now we are saying R equals to what? It is the retention ratio. Retention ratio. Retention ratio. Listen, your company has a dividend of 5 shillings. That is, earnings per share of 5 shillings. If out of 5 shillings they paid a dividend of 2 shillings, then they retained how much? They retained 3 shillings. So that was the retention. What they retained. When you are required to compute the growth rate, you ask yourself, what is the retention ratio? It is 3 divided by 5. Don't forget, the earnings per share was 5. The company retained whatever, which is the same as taking, listen, which is the same as getting 1 minus payout ratio. 1 minus payout ratio, or we can call it this way, dividend payout. Dividend payout ratio. Listen, let me explain what is dividend payout ratio. I think you have also done topic of ratios. Dividend, the earnings per share is 5. The company paid a dividend of 2 shillings. So what was the payout ratio? It is 2 divided by the earnings. So 2 divided by 5, that is 40%, which is the same as 0.4. No, 40%, yeah, 0.4. So our total earnings were 5. That represents 1. If they distribute everything, fine. There is no retention. Out of 5, if they distribute everything, then the whole 5 becomes the dividend payout. If they keep everything, then there is no retention. But if we made we have an earnings per share of 5, and you paid a dividend of 2 out of 5, what is your payout ratio? It will be dividend of 2 divided by the earnings of 5, that is 40%. So if 40% was the payout ratio, what was the retention ratio? The retention ratio, therefore, is 60%, which is the same as taking 1 minus the payout ratio. Hope you are following. Our payout ratio, we were saying, if the earnings, listen, if the earnings per share was 5 and the dividend per share was 2, then the company has paid a dividend of 2 out of 5. So the payout ratio, the dividend payout ratio is 2 divided by 5 times 100. This is what we are calling 40%, which is the same as 0.4. Then out of 5, they retained how much? They retained 3. What is the retention ratio? It is the same as taking 3 divided by 5. That is what they retained. 3 is the amount they retained in the company as retained earnings, times divide by 5 times 100 is the same as 60%, which is the same as 0.6. Otherwise, I'm also saying you can get the 0.6 by taking 1, which is the whole number 1, you minus the dividend payout ratio. Our dividend payout ratio was 0.4. Okay, good. Then, listen to this now. I'm not through yet. That is R. Our R represents the the retention ratio. What about BE? What about BE? BE represents what? It represents the return on equity. Return on equity. The examiner will tell you what is the return on equity. The return on equity is 20%, 30%, 40%, and so on. It's a ratio like any other, but normally the examiner will give you and tell you the return on equity is 20%. So if you know the retention ratio at 60%, which is our assuming 0.6, maybe you are told the return on equity is 20%, multiply those two and you get the growth rate. And you get the growth rate. Are you there? Good. So those are the two methods of determining the growth rate. Those are the two methods of determining the growth rate. So andika somewhere, NB. NB, we are still discussing the cost of ordinary MACU. Then you say this, NB, where the growth rate is not given, where the growth rate is not given, where the growth rate is not given, then there are two methods of calculating it. There are two methods of calculating it. There are two methods of calculating it. One, compounding method. Compounding method. Compounding method. Then you can copy this formula. I don't have to rewrite it. I don't have to rewrite it. I don't have to rewrite it. Sema G is equals to n minus 1 root dn divided by do minus 1 minus 1. Then you say below that dn, after you have copied the formula, say this dn equals to the most recent dividend per share. The most recent dividend per share. The most recent dividend per share. DN equals to most recent dividend per share. Then DO and the couple past dividend. Past dividend. Past dividend. And then N, number of years. Number of years. Number of years of dividend payment. Number of years of dividend payment. Number of years of dividend payment. Then you can put down EG. That's andika hapo EG. This is a simple illustration. You don't need to write a complete illustration. Just come and see a D note is 8, D1 8.1, D2, D3 9, D4, 9.6. That is what I want to use now. That's what I want to use. Then after that, you can even show the growth, first growth, second growth. This is first growth, just to remind you when you are revising. This is second growth and third growth. So there are only 3 growths in this series. Okay. Then below there, you can now come and say G equals to, and now copy the next part. G equals to 4 minus 1 root 9.6 divided by 8 minus 1. Copy that. G is equals to 4 minus 1 root 9.6 divided by 8. 9.6 is the most recent dividend. 8 was the first dividend that was paid according to the record of the company at the record of the question. And everything you minus 1. Everything you minus 1. Then we move on and still say G equals to 3 or the third root of 1.2 minus 1. Third root, that. Good. Then you copy the remaining part of the calculation. Then you end up with a G of 6 point. This is G, 6.27%. 6.27%. Good. Okay. Finish. We don't have to put down the recall, how we derive that. I was just trying to show you how we recall or how we determined the R or the G by recalling this formula of the present value, no, the future value factor. Okay. So we are just using it to try and see how they derived at our formula. Otherwise, you don't need to copy that component. No. Then you can come and say number 2, method 2 now. Method number 2 now. Method 2. Method 2. Andika retention ratio method. Retention ratio method. Retention ratio method. Retention ratio method. And you say G, which is the growth rate, equals to RBE. Then you can quote what the R represents. You can quote what R represents. I've said R is equals to retention ratio, which you can get by taking 1 minus the dividend payout ratio. I've already explained payout ratio, dividend per share divided by earnings per share. That was the dividend ratio or the dividend payout. If you want to get the retention, you can also take the retained per share divided by earnings per share. Then BE, you will be given, we are calling it the return on equity. That's a ratio you will be given. What is the return on equity? It is 20%, 15%, whatever it is that the examiner will give you. Okay? Good. So today, we have discussed how to compute the cost of ordinary shares, and there are various ways of computing it, whether it is a dividend price model or the dividend growth model or the earnings price model. Those are the 3 approaches we have discussed. Then we have also discussed how to determine the growth rate. Okay? We started by saying, how do you use the dividend price model? Dividend price model is used where there is no growth. Okay? In other words, there was no growth in dividend and we expected dividend to remain the same forever. That was our first approach. I'm just summarizing just to remind you, where we said that KE will be given therefore by D divide by PO, okay, where there was no growth rate. Okay, good. Just take the dividend, divide that by the market price. Okay, I told you this gives you the dividend yield. When you take dividend divide by market price, it's the dividend yield. And dividend yield represents what? The real return on your investment. What me as an investor I'm expecting as a return, which is this D minus D divided by market price, because if I'm paying you 50 bob and I'm expecting 5 shillings as dividend, I pay 5.50, that is the market price, denominator, I get a return of 50 shillings or 5 shillings, my return is 10%. 5 divided by 50 as a percentage is 10%. So that is my dividend yield, which becomes your cost as a company. So what me I'm expecting as my return, that is what becomes your cost. Then from there, I develop the formula and we say, what if we have some growth? What if we had some growth in terms of dividend? This is the one where we're assuming that the growth rate is not there. The dividends remain constant forever. Okay? Then we went there and said, if there is a growth rate, then the formula becomes D naught into 1 plus G, divide that by P0 plus G. Okay? Where I told you there's a way to derive this formula, but that was whatever we say. Then I told you, if you take D naught plus into 1 plus G, what does that represent? It represents the expected dividend. Remember, D is the dividend they have paid. What is the growth? 5%. So we expect it to grow by 5%. So we expect a dividend of how much at the end of the year? This much. Whatever we're expecting now becomes D1. Okay? Where we said you can now take D1, divide by P0 plus G. That's the formula we have used. Okay? Then after that, I went further and introduced the concept of the cost of flotation cost. I told you if there is a flotation cost, then in the denominator, you just minus from the P, you minus the flotation cost. Then today we have also said, I talked about how do you get the growth rate if the examiner has not given you the growth rate. We have said there are two formulas. One is the compounding method. We have already said G equals to n root minus 1 into D1 or Dn divided by Do minus 1. Okay? That is the formula for getting the growth rate. Alternatively, you take the retention ratio times, that is, times the return on equity. Good. That's where we can stop today. Maybe next time now we shall go to the second component of cost of capital. We have discussed ordinary shares. The rest we have no many methods. It's just one for every method, every cost. Okay? What we shall discuss next time is the cost of preference share capital. That's what we shall discuss next time. How do you calculate the cost of preference share capital? What I just want you to know is that when it comes to preference share capital, listen, you either have what we call redeemable preference shares or non-redeemable preference shares. We have two types of preference shares. We have what we call redeemable and non-redeemable. How to compute their cost depends on whether you are dealing with a redeemable preference or you are dealing with irredeemable preference shares. That's what we shall discuss next time. After we have discussed preference shares, both redeemable and non-redeemable, how to compute their dividends or their return, or what we call the cost, then we can now go on and talk about how to compute the cost of debt, or in other words, cost of debenture. Cost of debenture. Listen again, debenture can either be redeemable debentures or again, non-redeemable debentures. You can issue debentures which are to be redeemed after 10 years, or you may issue debentures which are non-redeemable or irredeemable. How to compute the cost of those debentures or debt, that's something we shall discuss in our next lesson. Maybe we can stop there for today. We pick it up from there next time. Again, just to remind you, please subscribe. If you have not subscribed to my YouTube channel, I've said, please subscribe by clicking that subscription button down there. That's what I've said. Hope you have understood something today. If you have understood something, click the like button, like the video. Click that like button, like the video. Then I've also told you, if you have friends who, or maybe you are watching this FM, that is financial management, and you would also want to join financial reporting, fine. That is it. Good. We said, tell your friends, we have online classes for financial management of the intermediate, financial reporting of the intermediate, advanced financial reporting of the advanced level, and financial accounting of the foundation level, and the one we said of ATD1 and ATD2. Then I told you, if your friends cannot join the live classes, then they can buy what we said, the pre-recorded videos, okay? Then I said our number is 0722 658875. Good. Those are the numbers. That's the number 0722 658875. Okay? Good. Maybe we can stop there for today. We pick it up from there next time. Bye for now. See you then.